The next part of this chapter we have swap contracts. Contracts. So we are talking about another derivative instrument which derives its value from underlying. Futures we have options, forward contracts. Now we have swaps. What is swapping? Swapping is what I have, I give it to you. What you have, you give it to me. Correct? So we are exchanging something, and for exchanging something we are getting into a contract. There are different types of contracts. So I am giving you a general meaning. We swap things and we put it in writing whose value is derived from some underlying derivative contract. Swaps are flexible contracts used to exchange cash flow structure without changing the underlying principle. So we are not changing the main principle, the underlying, but what we are doing is we are swapping some cash flows that I am supposed to receive. It can be as simple as some cash flow which I have to receive after 3 months. I'll ask you to receive that, which you have to receive, I will receive that. As simple as that. Parties exchange cash flows at specified intervals called settlement dates. Correct? I can talk about one instrument like this. So you have one investment in FD. I have one investment in equity. Okay? But for the next 2 months, I say whatever return you are getting from FD, that you have to give it to me. Whatever return I am getting from my equity shares, that you keep. Just for 2 months arrangement. Why? Because of whatever reasons. Because I want to maybe hedge, maybe I want to switch from equity to debt for a certain number of months. For whatever reasons I may get into this. But we are exchanging our cash flows, principles will remain as it is. Payments can be fixed variable based on reference rate. So all the terms as to how we exchange the cash flows will be in writing. Main type includes one we have interest rate. See, interest rate we have one called fixed interest, fixed rate. Both are F1, fixed and floating. So we'll write fixed and floating. We can exchange currency. Currency we can exchange. We have USD, INR, or any other currency. We can swap the currencies. Commodities also we can exchange depending on whether you want a fixed rate or a floating rate. And equity swaps also, the example that I've already given. We'll be taking each of them in detail. Okay, so that's why I'm not covering in detail right now over here. Payments are typically netted with only difference paid. So like I told you, only the difference will be paid. Now for example, in the first example that I gave, we agreed to swap our returns. You are having FD, your returns from FD are given to me. I have equity shares, my equity shares return is given to you. But we will not literally be giving each other money, we are seeing the net difference. What one person has to receive, what one person has to pay. Fine, no delivering, nothing, only the net difference is transferred. One person's gain is another person's loss. This is true for all derivative segments, whether it is forward, future, options, and now we have swaps. Mainly used by large multinational companies and corporations. Small people, the retailers do not use much of swaps. Swaps are customized. So it is not like it is traded over the exchange. It is customized between me and you. We talk, we get into the terms, we decide which cash flows will be exchanged, and so on. That's why it has credit risk. Credit default risk is that you may not honor the contract. Possible. So because it is not standardized in the exchange. First we have is interest rate swaps, explained in detail in risk interest rate risk management. It's a separate chapter, chapter 12. Like I already told you, we have fixed and floating. In simple, if I had to explain, I have one loan of fixed interest, you have a loan of floating interest. For whatever reasons we feel in future, I want to switch, you want to switch, you want fixed, I want floating. Instead of changing our loans, I mean closing my loan, you closing your loan, taking a new loan, we get into a contract. Whatever is the difference between the interests, that will be paid off. Fine. In detail, we will learn this in a separate chapter. Now we come to currency swaps. Currency swaps we are doing over here only because we are talking about forex, right? Yes. The currency swap involves exchanging liabilities in different currencies. So I need two currencies. One I will take US, one more I will take India. Here we have Mr. Yen in US. Here we have Mr. B in India. Two people are there. Okay. Do it over here. There is more space. Okay. What does he have? He have loan of rupees 10,000. Not rupees, US dollar. He's in US. Sorry. Yes, loan of dollar 10,000. Okay. Now what is equivalent to 10,000? In rupees, we will take exchange rate of 90. So we get 9 lakhs. And Mr. B as a loan of 9 lakh. Mr. A as a loan of 10,000 USD. Mr. B as a loan of rupees 9 lakh. If I apply the exchange rate 1 USD equal to 90 rupees, we get this. Correct. So both are having equal loan as on today. Now this is repayable after 3 months for both of them. Okay. This is repayable after 3 months for both of them. Also, I have to receive receivable of rupees 9 lakh after 3 months. And Mr. B has receivables of US dollar 10,000 after 3 months. After 3 months, we don't know the rate. Right now it is 90. Now two people have something similar going on. One person has to receive rupees, that is one in US has to receive rupees. Other person has to receive dollars. Now these are saying that okay, we are scared. Scared of what? Fluctuations. Currency keeps changing. Now both are scared that the other currency will depreciate. The one in US is saying Indian currency always depreciates. I am supposed to receive 9 lakh after 3 months. Now right now it is 90. What if it becomes 100? If it becomes 100, 9 lakh divided by 100, I will get only 9,000 US dollars. Right now it is 10,000 US dollars, but after 3 months the currency depreciates, which is very likely from US point of view. I will get less. But the Indian guy is saying no, ours is a growing economy. This time we will appreciate. I have good reasons to believe we will appreciate. US dollar is collapsing, so that will depreciate. Now if I have to receive 10,000, great, $10,000. But then if exchange rate comes to 80, that is appreciation of rupees from 90 to 80, then I will not get the amount that I was looking for. So both have their concerns, so they get into a contract. Now we will have a swap contract. Swap. Mr. B pays Mr. A's loan and Mr. A pays Mr. B's loan. So we have like agreed, no? The exchange rate is 90. Or we can agree on whatever, like ultimately we can say that it's 92, so you pay this much amount extra to me. All those terms can be there. I have kept it simple. I am saying Mr. B is supposed to receive after 3 months from that 9 lakh rupees. He'll say that money I will, Mr. B has to receive US dollar. Mr. B has to receive US dollar. He will say after 3 months that I will use it for repaying your loan. Mr. A says I will receive 9 lakh in India. That I will use to repay your loan. Both are happy now. So that's how we exchanged. Mr. B exchanged with Mr. A's liability. That's what is given over here. This is a swap contract. Exchanging liabilities in different currencies. My liability, you're paying, your liability, I am paying. I have not taken it to extremes. I have not spoken about interest and all of that. Interest that is to be paid and all of that. Even those can be put in terms. It typically has 3 stages. One, initial exchange of principal, which I have already spoken about. Periodic exchange of interest payments. That also we can talk about because our interest rates will be different. You will have you will have Indian rupees loan of 8%. I will have US loan of 6%. So that difference is also there. We can speak about it. How are we going to cover it? Who is going to pay how much? Everything. The terms of the contract. But liabilities we are exchanging and the currency should be different. If liabilities are exchanged and if the currencies are different, that becomes a currency swap. Interest rate payments are usually based on agreed rates and often linked to initial exchange rate. It helps hedge currency risk. It is not about profit over here. The person in US hedged is receivables. The person in India hedged is receivables, which is happening in 3 months. It can reduce borrowing cost by assessing markets where a borrower has a better credit advantage. This is another way. Now let's say I want to make some investment in India. I am from US and I want to make some investment in India. I need loan in India. But if I have to go and ask for loan in India, they will doubt my credibility. I am not even a citizen first. I may not even get loan. So what I'll do is I'll ask you to take loan. You are from India, you to take loan. Okay, you have taken loan. Now you have to make some investment in US. You will not get loan in US. So I will take a loan over here. Then the same thing continues like what I explained already, exchanging liabilities. So we will get access to the markets where we will actually not getting loan. If I want to go to UK, we are let's say from India, we want to go to UK. Will we get loan over there? No. So I'll catch a person who wants loan in India and he is not gonna get. I won't get loan in UK, person in UK won't get loan in India. So we come together, we have an agreement as to how we are gonna swap this. It allows access to funds in currencies that may otherwise be expensive. So one, you will not get on. Second, if it get also, it will be expensive because the credibility is not there. I am coming from US, so instead of normally people getting 8%, I may get it at 10%. It is expensive. So I'll ask you to take loan. If you come to US, for you it is expensive. So we'll take the cheaper loan, both of us, and then we will exchange. It helps diversify sources of borrowing. A variation in the currency coupon swap. This is currency coupon swap, what is also called as circle swap. Even interest payments are exchanged. Okay, they're not getting into details there, which exchanges different types of interest payments across currencies. Principal in the currency swap may be exchanged at the beginning. We exchange the principal amount, or sometimes it can be done at the end also, both or not at all. Sometimes you don't exchange at all. Sometimes we exchange at the beginning, sometimes we exchange or we don't exchange principal, we do only exchange interest. So different things that we can do. All that should be included over here is something to do with currencies. And we are swapping. That is, my liability is yours, your liability is mine. Involving different countries, that is currency swap. Let us take up a question to understand this concept even better. This is from currency swap. Drill Dip Incorporation, a US based company, as won a contract in India for drilling oil fields. We are from where? We are from US. Change the color. We are from US. We means Drill Dip is from US. Now the contract is in India. The project will require an initial investment of 500 crores. I need this much money for investment. The oil fields along with equipment will be sold to Indian government for 740 crores in 1 year time. Right now my investment is 500 crore. After 1 year I have 740 crore inflow. Okay, right now this is year 0. I have 500 crore outflow. Just writing it down. 740 crore inflow. This is when? Year 1. After 1 year. Since the Indian government will pay the amount in Indian rupees, the company is worried about exposure due to exchange rate volatility. Right now's investment, fine, I can do that. I know the exchange rate. But after 1 year, the 740 crores that I'm going to receive, what may happen because of exchange rate volatility? See, first I may think 740 crore I'm getting minus 500 crore that I'm investing, 240 crore is the profit. Possible. 740 crore, if it depreciates, That is, when I now invest US dollar 500 crore, sorry, US dollar, when I convert it to 500 crore rupees, I will have an exchange rate. But when I convert 740 crore, if I have a different exchange rate, then there is some risk. It may go in my favor, it may go against. Risk is there. I cannot be certain that what will be my profit. So because of this volatility, you are required to construct a swap that will help build it to reduce exchange rate risk. So what can we do over here? Let's construct a swap agreement. Okay, we'll write it down. First, what we'll do is step 1. What will we do in step 1? We will swap a US dollar loan today. That means we will have a loan, we'll swap our US dollar loan, obviously with what? With an INR loan at an agreed upon exchange rate. So basically, I will take a loan in US. Means the company will take a loan in US. We'll find somebody who will take a loan in India. We will make sure it matches, like how I gave it in the example, the earlier example, you remember, 10,000 and 9 lakhs, something like this. Okay. After taking loan, we will swap our loans. So what will happen? I will receive money in India out from the loan that is taken. Another person will receive money in US out of the loan that I have taken. So we have swapped our loans at the agreed upon exchange rate to fund the initial investment. To fund the initial investment. So initial investment is done. How much? Of rupees 500 crore. So my first part is sorted. This part is sorted. Fine. Step 1 is done. Step 2. After 1 year, I'm going to receive that 740 crores. So what we'll do is, after 1 year, we will swap back the Indian rupees. We'll swap back the Indian rupees with US dollars at the agreed rate. We'll take back our loan. We'll say we will only pay the loan amount. First we had agreed that whatever loan I take, you will receive. Whatever loan you had taken, I will receive. Now who has to repay the loan? Repaying the loan I will only do. My loan, I had taken the loan, I will only repay. You had taken the loan, you only repay. Correct. So with this, what happens? The 500 crore nullifies. After 1 year, swap back Indian rupees with US dollars at the agreed rate. In such a case, the company is exposed only to the extent of profit earned. That is 740 crore minus rupees 500 crore, which is rupees 240 crore. This is not covered. This much amount is not covered. Remaining everything is covered. I'll just repeat this concept once again. I took loan in US. You took loan in India. Your loan, I received the money. My loan, you received the money. Sorted. So that I got my 500 crores. Now, after 1 year, I agreed to pay back the loan that I had taken in US on my own. It is my responsibility. With the loan which you have taken in India, you only repay your loan. 500 crores sorted. You had got no indirectly the 500 crores in the beginning in US. Now that you have to repay in India. The money that I got in India, I am repaying it back in US. With that 500 sorted. Now we have 240 crore remaining. 240 crore has to be exchanged after 1 year at the prevailing exchange rate. Done. Swap is completed. This is the swap contract. I hope it's clear. Fine. We will go to the second part. Assuming that Indian government offers a swap at spot rate which is $50 in 1 year, then should the company opt for this option or should it just do nothing? The spot rate after 1 year is expected to be 54. Further, you may also assume that DRIP can take loan of 8%. Fine. So for the second part, we will see with the option that is given by Indian government. Indian government is saying after 1 year we will give you fixed rate. What is the fixed rate? $50. What is the rate right now? Right now rate is 50. So government is saying right now rate is 50. Now you make investment. After 1 year also we will give you 50 ka exchange rate only. First only we are giving it in writing. Okay, and should the company opt for this option or should it do nothing? So first we'll see if you accept the proposal from the Indian government. Evaluation of proposal from Government of India. Government of India is saying you take loan in US, convert it today at today's spot rate. How much? 500 crores, because that's what is required for investment. Same 500 crores we will swap it back after 1 year. Remember, only for 500 crores, because government says whatever you exchange today, whatever you buy from me today, basically when you're exchanging, you're buying rupees. Whatever you buy today, buying at 50, same thing I will sell at 50. I will let you sell at 50. If I am from US, I am buying rupees at 50 per dollar. Later when I will be selling also will be at 50 per dollar, only to the extent of 500 crores which was done in the beginning. Fine. So in the beginning we will have to write buy rupees 500 crore at rupees 50. Okay, we'll write the answers in US dollars since it is a US firm. So we have 500 crores divided by 50. I get 10 crore. But since it is dollars, let me write it as 100 million. 10 crore is 100 million. 10 lakh is 1 million. 1 crore is 10 million. 10 crore is 100 million. So we bought, and this is my investment. So it will be within bracket. Next, after 1 year, what do I need to do? Swap rupees 500 crore at rupees 50. This is the agreed upon rate. First only I had agreed. I am now buying it at 50. Later, I will sell it at 50. So we will get back the same amount. No need calculator this time. Last time it was outflow. This time it is inflow. Dollars are coming back. You're selling rupees, dollars are coming back. But what is the difference now? Difference is not edged. Which difference am I talking about? I am receiving more than 500 crores after 1 year. Correct? Now that has to be sold. Sell rupees 274. No, 274 or something. 244. What is the value? 740. 740 and 500. So we have 240. We have 240. Okay, sell rupees 240 crore. Sell rupees 240 crore at what rate? Now what is the exchange rate? We will have to go for 54. This is not edged. At rupees 54. So we will convert this. 240 divided by 54. We get 4.44 crore. 4.44 crore is $44.44 million. This is also inflow. In addition to this, I have taken loan in US Without that, I had no money. And they are given specifically, right, in the question, you are taking a loan at 8%. So I have to pay interest on that principal amount you are not taking, because even for taking loan, I have not taken. So we'll take only the interest on USD loan at 8%. So we have 8% of 100 million, $8 million. This will be again within bracket, since it is cash outflow, and this will be your net result or net profit. 100 and 100 cancels, 44.44 minus 8 if I do, I get 36.44 million. This is if you accept the proposal from the government. This is with the swap. If you go without swap, this is if you go without swap. If you go without swap, you still have to do the same thing. Buy rupees 500 crore at 50. This will not change. Why will this not change? You still have to make the investment. This will still be your cash outflow. Continue this line. Okay. But after 1 year, what happens? After 1 year, sell directly 740 crores at rupees 54. 13.7 I get, so 137 million dollars, 137 point something. Okay, should I write, because it is in millions? Okay, 137.04 million. Directly you are getting this. Definitely you have interest, which will not change. That's why I said interest is not really relevant. It is there for both. Okay, so we will take 8 million US dollars from it. So here all three has to be calculated. If you don't go for swap, you invested 100 plus you lost 8 million in the interest, minus you got 137.04. So you got 29. Net is 29.04 US dollars. 04 million US dollars. Now what should you go for? Now if you see, if you go for swap, your net profit is 36.44. If you do not go for swap, your net profit is 29. And we like more profit. Since the net profit with swap agreement with Government of India is higher, the company may accept the offer of swap contract. So we'll accept the contract. Fine. So that's done. This is how you get into a swap contract. First, here we are given a blanket swap agreement as to what we can do, step 1 and step 2, where we take loans in our respective currencies and then we switch. That should receive that money. And at the end, we will again agree to pay our own loans. That's the first part. Second part is where we had an offer from GOI, where we got a fixed rate. See, each contract is different. It need not be same. We will have to draft it accordingly. So if you take the fixed rate, we got the net inflow, and if you don't take, we know what will happen, and then we will compare and give the conclusion. Next we come to commodity swaps. It is a series of future-like contracts, okay, with settlement over multiple dates. It's future-like contract only, but settlement is there. What happens in future? If you buy future today, let's say at 100 rupees, it goes to 102. That mark to market is there. So something like that is there over here also. These are swap agreements on commodities. Commodities can be bullion, gold, silver. It can be crude oil. It could be some other commodity. So many commodities are listed now. It could be a commodity which is not listed also. Payments are based on notional amount. Settlements use predetermined reference prices or commodity indices, can be applied to various commodities, commonly used to hedge oil prices. Write it quite fast because I'm going to give you an example. Now we'll take one particular company which uses highest oil. Let's talk about Indigo. Indigo is into aviation industry which requires a lot of oil. Now Indigo needs oil. How much? Let's say it requires 10,000 units. Okay, whatever the measurement is, let's say 10,000 units. I'm going on the lower side of the 10,000 barrels basically. Okay, and we have agreed upon a particular rate. Okay, which is, let's say, usually it's quoted in dollars. No, let's say $80 per barrel crude oil. $80. Every month we'll need this. So we are scared. Right now it is at 80. But what if it goes up? We'll have to pay more. Correct? Our ticket booking is done in advance. Later we cannot claim it from the customers. No? So it is at 80 right now. So this Indigo company gets into a contract, swap agreement with some person. Let's say Mr. A. Or A Limited, let's say, make it a company. A Limited. Fine. So the contract would be like, on any particular date, let's say end of the month. End of the month we'll see the rate. Now if it is 85. If it is 85. Then what happens? If it is 85, A Limited pays $5 to Indigo because we had agreed at 80, only the difference amount. Acts very much like futures. Futures also something similar happens. Now what if it comes to $70? You cannot have one way, so then Indigo pays. Indigo pays how much? $10. So basically ultimately they are paying how much? They are paying 80 only. How does that work? How do they pay 80? Now let's say it has gone to 85. Indigo will be paying 85. This contract is private. Indigo, when they buy, they'll buy it at 85. And then on that day, they will receive 5 from A Limited. So net on net, they're paying 80. If it goes to 70, to the outsiders, they're paying 70. When they buy oil, they're paying 70. Another $10 they will pay to A Limited. Ultimately, they'll end up paying 80 only. So only this cash difference is settled on periodic basis. It could be on daily basis, monthly basis, yearly basis, depending on the contract. This is commodity swap. I hope it's clear. We'll read it now once again, make better understanding. It is a series of future-like contracts with settlements over multiple dates. It acts like futures only. Payments are based on a notional amount. Some amount will be in that is, I'm talking about 80. This is the notional amount that we're talking about, based on one particular reference rate. Settlements use predetermined reference prices or commodity indices, can be applied on various commodities. You can do for anything, commonly used to hedge oil price risk. This I've given example also of oil price only. So Indigo, irrespective of what the price is, ultimately will end up paying 8. Definitely the other person will have his own estimates. Indigo has its own estimate. So based on expectations, one person's gain is another person's loss. That's commodity swap. Next we go to equity swap. Equity swap is a contract to exchange returns on equity or an equity index. This I had explained in the beginning. When I was explaining swap, one of the type of swaps that I can talk is, you are having FD, I am having equity. Your returns I will take, my returns you take, over done. Okay, so we have equity. Here we have FD. Both have 1 lakh. 1 lakh here, 1 lakh here, investment. Now this 1 lakh has become 1,10,000. Let's say after 1 year. FD, fixed rate of interest, will give 8% return. we will get 8,000. That is 1,08,000. After 1 year, both are happening after 1 year. In addition to this, 1 lakh became 1,10,000 plus you have received a dividend of 2,000. So what is the total return? 1 lakh became 1,12,000. Total return, net return, you get 12,000. That is capital appreciation is 10,000 plus 2,000 in the form of dividend. FD ka net return will be 8,000. Now we will swap. What is the difference? 4,000. 4,000 who has to pay? E has to pay, that is equity person has to pay. This is Mr. A. This is Mr. B. So A pays B. I will just put one way arrow. Okay. 4,000 A pays B. Two people are there. One is having equity, one is having FD, and we are exchanging returns. That person wanted. Now B wants equity exposure for some reason, and A wants FD returns. What could be the possible reason? See, A is thinking that next 1 year equity will not do well. B is thinking next 1 year equity will do well. Obviously, two different expectations have to be there. Otherwise, there will never be trade. One person has to buy for another person to sell. So they will exchange. After 1 year, it will come back to them only. So this is a contract. They do not want to sell and buy and all of that. See, if A wanted FD, then what he had to do? He had to sell his equity shares, buy FD. B wanted equity shares, so he has to close his FD, buy equity. Instead of that, we will just take the difference and both of them are happy. This is equity swaps.